pretend you own this, and what strike would you buy? What how far out? Let's give them a real world example.
Okay, so you want to first have plenty of time. Again, when I first started doing this, it was like, oh, I don't want to spend a lot of money, so I'd buy cheap puts. You get what you pay for. You and really, when you're hedging a stock, the cost of the put is not the cost of the trade. It's the cost of the spread. It's getting in and getting out. Because if you do it right, you're locking in this gain. So all right now, the January calls have about 60, I'm sorry, puts have about 66 days. So that gives you, about 20 days. So that's pretty good. Really, you start losing time value. It starts accelerating around 45 days, and then 30 days it picks up, and then it really plunges as that last month goes on.
All right,
So
let's look at it here on
okay,
TOS. So
so
I've got the option chain, and you want to
uh-huh.
look at December 4th?
No, the January.
Oh, January. Okay, the month. Here's the monthly,
Right.
and
Now scroll
here's
down.
tons of strike prices here.
Well, you've got all of them. Okay.
Yeah, I do.
All right.
Okay, so we're looking at Neo.
Now then you find the 50 delta 0.5, and I just do that. It's right there.
Yeah.
It's
You're talking
47.
about the call.
It's the 47 strike on the put.
Right. Oh, on the put. Oh, okay. Right here.
Remember,
There
buying
it is.
puts.
Right there.
Okay.
Yep. Yep.
And
Right here.
the reason for doing that, it makes it easy to size. So if you've got 100 shares you buy and you want to be completely hedged, you buy 2 puts. Okay. Because the delta says, how much is this going to move given the underlying move in the stock? And so if you want to completely lock it in, go with a 50 delta and buy twice as many shares short as you have long. And that, in this case, 100 shares would require 2 puts. So we look at the 47 put, and what's the spread between the bid and the ask?
Right now it's about 45 cents.
Okay,
The bid is
that's
11.45.
in options. That's nothing. I would. So if I had this, I would buy that 47 put right now at market, and be happy that I'm locking in a gain, because there's a couple things going on. This thing has been going vertical. The market is showing some weakness. There's a rotation, and we've got this news out of China today that they're kind of going heavy-handed on at least the bigger companies. This is a smaller company, so that's how I would do it if I were sitting with this right now. And the nice thing is, look, as those puts get deeper in the money, what happens? That delta goes up. So let's say this thing drops 10 points. And if we're looking at the 47, if we go to like the 55, you'd have a 61 delta. And so that means you're actually making more on your put than you're losing in your position of shares. And so you can definitely, if you play these right, let's say this comes all the way down to the 50-day and then gets support, you could then sell your put, and you would be better off at the 50-day than you were right now at 41.19.
I think the bots are listening to us.
I know.
I swear, I'm not a conspiracy theorist. They must, because as soon as we mention something, these stocks move. It's incredible.
Well,
it's down $1 since you started talking about the stock.
That's significant. Yeah. Well, we have a lot of listeners.
Yeah, we have a lot of people.
Yeah, and just to reiterate here, this is the January 15th expiring put option. The right side of this data is all puts. The left side is calls. So we're only looking at the puts, which offer you the right to sell a stock at a given price, which is the strike price. Right. And just like what Chris is mentioning, these negative deltas reflect how much you expect the price of this option to move relative to a 1-point move in the stock price. So therefore, Chris is suggesting, well, for 100 shares of stock you want to hedge, you want to buy 2 options, which gives you the right to sell 200 shares worth. You're not necessarily going to be trying to sell those in the future. You're just trying to make some profit off the option, right, Chris?
Or
exactly.
And look, if it's
Yeah.
a hedge and you lose on the option, you can't be upset. That was the idea, right? It's like insurance on your house.
Right.
Like Bill would say, if your house doesn't burn down and you're upset, you had the insurance. But this is not a speculative play that you think it's going down. It's you're worried about the short-term action in the stock, and you just want to kind of lock in this price, so to speak.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.